You want to become a better property investor, a better business person, a better professional. Well, what's standing between you and that success you're looking for? Now, it's probably not knowledge. It's probably not the things you think. It could be you. Maybe you're too biased to be a successful property investor, business owner, entrepreneur. Now, what's Michael on about? You're probably thinking, well, did you know that as investors, even as entrepreneurs and business people, we can sometimes be our own worst enemy? And it's not because of the decisions we make or the opportunities we consider or the investments we miss out on, but rather it's because of the way we think. It's because of our cognitive biases. You see, most of us think we're rational people, but we're not. There's no shortage of cognitive biases out there that trip us up, that trip up our brains. See, cognitive biases are patterns of thinking that don't rely on logic. Cognitive biases may convince you to spend more, to save less, to feel more confident in your decisions than perhaps you should be. And the scary thing is, for the most part, we're powerless against them. But because these things I'm calling cognitive biases allow your mind to get around gaps in our knowledge or gaps in our memory, we need them to bypass things like extreme pressure, time constraints, emotions, or overwhelming information. Now, don't worry, I'm going to explain a lot more about this with my chat with Pete Wargent in just a moment. But because cognitive biases are based on generalizations and assumptions, they're not generally correct. And if you don't check your reasoning, it can lead to judgment errors. It can lead to incorrect decisions. It can impact on your business, on your success as an investor, on your entrepreneurship. Now, you can't eliminate cognitive biases, but when I'm having a chat with Pete Wargent, you're going to understand more about them so that you can be aware of them, how they function, and how you can counteract them. So, welcome to today's episode of the Michael Yardney podcast, and let's find out how you stand in the way of your own success.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
Have you ever wondered what's standing between you and property investment success? Well, some of us think it's probably that we don't have enough knowledge, or the banks aren't on our side, or we didn't get the right education. In fact, that's probably not the case. It's more likely that it's you, your internal biases, the way you think about things. Let's have a talk about why rational people do irrational things, especially in the areas of money, with leading finance commentator, economist and property commentator, Pete Wargent. Hi, Pete.
Hi, Michael. Always good to be here.
Now, we've spent a bit of time together at Wealth Retreat and at other times talking with very successful people, but even they've got their one foot on the accelerator and one on the brake. We have some beliefs that hold us back. But deep down below the beliefs, in my mind, there's these protective mechanisms, these biases that we think we're doing rational decisions, but we're not, Pete.
No, and I think, we're all subject to biases, and I think it's just the way that our brains almost try to convince ourselves that we're always acting rationally. But as we know, especially in investment markets, people do not act rationally. We see that over and over again, and it's these biases that lead us towards the behaviours.
Well, let's talk about some of those biases so that people can understand what we're on about. And I think one of the big ones in property, as in many parts of life, is actually this thing called confirmation bias. We tend to search for information that already confirms our views, those that we've set about the world, and we tend to ignore things that don't fit in with how we do it. Basically, we love to be right. It helps make sense of things. We look for more pieces of the puzzle that fit in with the puzzle in mind we've got, as opposed to different ways of looking at things.
That's by no means unique to property. I can remember back in my early days as an investor in the stock markets, the classic indicator of confirmation bias is when people buy shares in a company, and then after they bought the shares, they go away, find all of the information to support why it was a good decision. But of course, at that point, you've already made the decision, and it's really just an exercise in trying to confirm that you are right. And we see the same thing in property as well, because people tend to focus on a certain region or certain property type, and they just look for all of the reasons why they must be right and ignore any sort of contrary evidence.
Google doesn't help you though, Pete, because once you do a search on something in particular, it takes you down that rabbit warren, doesn't it? You keep getting things up on at the top of your search engine based on what you've already looked at, rather than maybe the other things, which is where you really should be looking.
Well, that's it. So they always say as an investor, if you want to actually get better, you should look at your faults. So the best investors like Warren Buffett, he would learn a lot more from his errors than he would from things that went right. The general idea really is to try and disprove your thesis as an investor. And if you can't find any holes in your strategy, then that's probably a good sign. But unfortunately, most people look at it the other way, and they look for all the reasons they must be right without really looking at some of the downsides and alternative scenarios.
So another way is to actually read other ideas, other sources, have a look at what other people are saying, rather than just accepting you're right. It's a bit like whether it's Apple or Samsung, Apple or Android, or Carlton or Collingwood, the football teams. We all have our biases. You say it correctly. It's in other parts of the world. Now, another bias is what's called anchoring biases, which is what estate agents and smart marketers use against you as well, because we've got a tendency to use particular reference points, or what I called anchors, to evaluate how things are. So I know recently I was in town, I was driving, and there was this car park that said $6 an hour, and I thought, gee, that's expensive. It's actually only for the first hour, then it costs a lot more. But there was another one that said $4.50 an hour, and so I went to that because I already had in my mind that $6 an hour is an expensive way of doing things, when in fact, when you dug into it, it ended up costing more because of the other little fees that they had. But the first number you see, especially when it comes to price, especially when it comes to negotiation, colours anything that comes afterwards.
Yeah, and price is the big one, but we actually do this all the way through life. So trying to think of an example. So that my parents are both smokers, and they're still alive, living into their 70s. So, people have, they sort of anchor to these things which may or may not be relevant. So I, maybe unconsciously think, well, if my parents have lived to nearly 80 and they were smokers, then, I should live to the same age. But it's not necessarily a logical conclusion. I think as an investor, the big one is really on the anchoring bias often relates to prices, as you say. So people might start with a high asking price. So then you feel good if you've offered less than the asking price. But of course, the price expectation might be completely wrong. So that's one of the ways that people get anchored. So it's important, I think, to avoid anchoring bias. There's a few ways to do it. One is to take some time out rather than making snap decisions based on the first price you see. Take some time to gather your thoughts and write them down, and maybe discuss them with an independent or trusted person. And also try and, just like with confirmation bias, just try and challenge yourself and consider how and why your initial anchor might be wrong. And usually the best way on price is almost become a statistician or a quant, and run all the quantifiable facts and figures that you can consider, and that will help you to move away from that anchoring bias.
Another one, I love the name of this, is the Dunninger-Kruger effect, where, let's be courteous about it, but it says something along the lines of dumb people are so dumb they don't recognise they're dumb. But that's not really, you don't have to be dumb to fall into this bias. It's an awareness, or lack of awareness, really, of how you're going, how you're performing. And with property, that has a lot to do with, it's good enough, it's working when people don't really evaluate how well their shares, their property portfolio is really going.
Yeah, you're right. Dunning-Kruger effect. The term is often used pejoratively these days, but actually, to a certain extent, it impacts all of us, particularly for investors. One of the big ones is just a level of overconfidence in your ability, especially if your early decisions go well. You tend to think, well, this is easy. I can do no wrong. And that overconfidence then leads people to over leverage and make mistakes. What you generally find is in all fields, not just investing, true experts are wise enough to know what they don't know, and they're knowledgeable enough to recognize what they don't know. Whereas usually beginners in most areas of life, but especially investing, they tend to attribute good outcomes to luck, to skill, when sometimes it's just luck. So I guess, it's very relevant to the journey of building wealth. And especially, there's an old phrase that a little bit of knowledge can be dangerous. And it's so true when it comes to leveraged investments.
Oh, sure. I mean, I've seen so many people who got it right first time. And that's the worst thing that can happen to you, because you think you're smarter than you are. And as you say, it was probably just that you were at the right time of the cycle or a bit of luck. And the other thing is, if you're really the smartest person in your team, you're in trouble. So I think the investor takeaway from this is work with mentors, work with professional advisors. I know you mentor property investors and share investors. You know that we do as well. And get somebody independent to review your portfolio with you. Because I think when we sit down, Pete, and speak with people once a year how their portfolio is going, they've just invested so much time, effort and emotion in it that they don't have a good perspective of how it's gone.
Yeah, particularly. I think whenever you're embarking on something new, a new subject, a new venture, you just need to be aware at the outset that you're prone to a lack of knowledge. And this isn't an ego thing. It relates to all of us. The way to tackle that, as you mentioned, get independent help, use expert help, and particularly always be learning. That's a very advantageous trait for people for avoiding these biases, is you can never know everything. So always be looking to learn, and don't make decisions in haste. Usually a more considered decision and slow and steady wins the race. I guess you just need to be wary of overconfidence and just recognize that you don't know everything, because none of us do.
Sure. So again, what we're talking about is these protective mechanisms that the brain has formed, shortcuts, I guess, Pete, so we don't have to make all these decisions. There are so many decisions, so many bits of information coming to us all the time. So we've got these shortcuts which don't always work in our favor, do they?
No. And in fact, the term bias itself should tell you that. They're things that cause us to behave irrationally. And that's why, we've seen in recent years, central banks around the world, they've been trying to smooth financial markets, stock markets, but you can never get rid of the business cycle. It seems for a period of time, it seems that can happen, but human behavior always just goes around and around in cycles, boom to bust, and it never stops, because it's these biases that cause people to get overconfident at the peak and too despondent at the bottom. And that's why the business cycle, the investment cycle just keeps on going.
Well, that actually leads to another bias, which we've seen a lot this year already, with all the terrible events that have happened, and it shows herd behavior with the coronavirus that came out earlier this year that created the worst stock market crash that we'd seen for years, even though the fundamentals weren't there to support it. And that's what is sometimes called bandwagon bias, the psychological phenomenon where people do something primarily because other people are doing it. They went out and bought toilet paper. They went out, it didn't make any sense. They stopped going to Chinese restaurants in Australia early in the piece when in fact it had nothing to do with the coronavirus. People tend to align their beliefs and behaviors with those people. It's that herd mentality. And I guess it does go back to, in the old days when we were on the savannah or cavemen, you stuck with the herd because you're less likely to be eaten by a saber-toothed tiger.
Yes, so it's definitely a human behavioral trait, and there is a certain level of comfort that we find and social proof in doing what everyone else is doing. It's often said that it's easier to fail conventionally than to go against the herd, and I think that's very true. But if you look at the great investors like Warren Buffett, he's been piling up cash for years now, 130 billion US, whatever he's sitting on, because he knows that these big opportunities come around when everybody else panics. So for a few years, people have been saying, "Oh, he's lost his touch," because he's, but he hasn't gone with the herd. He never does. And the old quote, "Be fearful when others are greedy, and be greedy when others are fearful." It is so true when it comes to investing. So It feels good to go with the crowd, but if you want outperformance and the better investments, and particularly to avoid asset bubbles, then you need to be able to a certain extent, just go against the herd.
Well, the herd's usually wrong, Pete, or they're late or they're early, and maybe that's wrong to a degree too. If you talk about property investment, we've been around long enough. I've seen the trends. They come and people have followed them and they've been wrong. There's been property investing in the United States. There was New Zealand property. There was timeshare. There was mining towns. There was vendor finance hotspots. And many investors we've been in contact with have got caught up in these things. They followed the crowd in the mistaken belief that others were doing the right thing, that it must be a good investment if others were doing the right thing. But it turned out in general that the herd was wrong. So I guess it's good to remember that you've got to do things differently, as you said. Otherwise, you're going to get the same results as most people. Now, going back to some of the other biases, let's discuss two that are almost seem contradictory. Some have a positivity bias and others have a negativity bias. But let's look at the positivity bias. Some people just so believe that property is a good investment. Any property is a good investment. They continue to view it in such a positive light, despite the fact that they're bought in the wrong area, the wrong location. They don't understand that not all properties are good investments. They're positively biased, and that doesn't work in their favour.
Yeah, I think it's important to distinguish, I think, between an optimistic outlook on the world, which I think people like you and I both have. I think that an optimistic outlook is useful because it helps you to bet on human progress and long-term great results.
Can I contradict you, Pete? I don't think it's useful. I think it's critical. If you want to get ahead, you have to have an optimistic outlook. That doesn't mean you've got to be unrealistic, but if you can't look for the good in things, you're just not going to move ahead.
Oh, totally. Yeah, and look, we all know people who have the opposite, and it's just a pessimistic outlook, and they will always find the problems in any investment, any decision. It's never the right time. There's always, if you want to look for reasons not to be positive, they're always there, and you can pick any year or any month if you like, and you'll always find reasons why the world's ending. So an optimistic outlook is important, but you don't want to take it too far where people sometimes have these irrational underlying beliefs. And you mentioned one, real estate always goes up. Well, yeah, but so maybe over the long term and as an asset class, but that doesn't mean that all property is a good investment. Yeah, so sometimes people can be overly positive, and that in itself is a bias which needs to be corrected.
Similarly, there's the negativity bias. Just like some are positive, some just always seem to find the negatives. They can't see the good things. Now, interestingly, there probably is a evolutionary purpose behind that. It was better to mistake a rock for a bear than a bear for a rock. So to keep our ancestors alive, Mother Nature helped us evolve this brain that routinely tricked them into making three mistakes: overestimating threats, underestimating opportunities, and underestimating our resources for dealing with things. So this was a great way to pass on the genetics of the people that survived. But Peter, in my mind, it's a really lousy way to promote a good quality of life or grow your wealth through property.
Yeah, totally, because it's pervasive. So it will not just be your outlook on investments or asset classes. It'll go right through your whole life. I think a lot of people have either an optimistic or a pessimistic view of the world, and that often shapes their long-term results. I think beneath that, something else is going on in terms of people's appetite for risk and their short-term outlook, because that really does fluctuate with what's going on. The classic thing is when you go to see an advisor and they say, well, what's your tolerance for risk? And people say, about average, like everybody else, because we never really have any context for thinking about this stuff. But if you go in to see an advisor and you glance up and see the TV screen, well, in fact, at the time of recording, I guess stock markets are down, 35% in 3 weeks. People are going to naturally say, well, I'm pretty risk averse. That's human nature. Even just a couple of months ago, the bull market, just going on the chat forums, everybody's saying you must be 100% invested. You're a loser if you're in cash. There's other stuff going on beneath the surface, and that's just reacting to what's going on at the current time. If you want to be a long-term successful person, wealthy, happy, successful, probably an optimistic outlook on the world is I would say critical to that.
Definitely. Another bias that holds us back from moving forward is the status quo bias, which describes our tendency to stick with what we know, whether or not it's the best course of getting where you want to get to. I mean, we see this with things like banks. People don't change their loans because even though they haven't got necessarily the best interest rate, or maybe something even more simple, you just get the same groceries, the same brand of cereal at the supermarket. People sometimes do this because they don't want to go to the cost or the expense of the time. But often the benefits, the potential benefits are much greater than this. So this is another form of loss aversion. Maybe they're a bit worried about jumping to something different, Pete.
Yeah, that's what it's really about, the status quo bias. It's really that fear of loss. And studies have shown we feel the pain of loss twice as much as we enjoy gains. And in fact, in recent weeks, there was a day when the stock market's bounced by 5%, but then yesterday market's down 10%. That didn't feel just twice as bad. For people who got caught holding the bag, that would have felt 4 times as bad because that's loss aversion. People feel the pain of loss much more than they enjoy a gain. And there are all kinds of psychological tests that you can do in terms of, would you rather have a guaranteed 50%, or would you rather take a risk to make more? And all the time, people's decision is skewed towards loss aversion. So that's why people have this status quo bias. And it's just a tendency, as you said, just stick with what you know, not because it's the best thing or the best course of action. It's just so you don't have to face that pain of loss or change.
Well, again, that's one of the reasons I know you have mentors. I have mentors. In fact, we share some mentors together with Mark Creedon and Business Accelerator Mastermind. And we both have clients who come to us to get external advice, because when you do that, when you've got other people chatting with you, they see your blind spots, they see your biases, and it helps them move forward. Now, once a year we do this, we get together at Wealth Retreat where you and I and a small faculty of people sit in a room with very successful business people, entrepreneurs and investors. And I know we personally get a lot out of it, and I know the people there do as well, because they're dealing with another group of already successful people, but we actually question some of their beliefs and they come out with a new set of beliefs, Pete.
Yeah, so I know from a personal perspective, if I want to, say, double my business revenue or turnover, I mean, I'm not going to do that by hanging around with people who are negative or unsuccessful. They say that success leaves clues. So that's why, as you said, all successful business people, entrepreneurs, investors, they like to mix with optimistic, successful, like-minded people. Things like the Wealth Retreat. I mean, the educational content is a huge part of that, but also just being able to bounce ideas off and mix with like-minded people. That's where I get a lot of the benefit. Success leaves clues. If you can learn from people who've been there and done it, even just unconsciously, you'll start to replicate their behaviors, but you can shortcut the route to success for sure.
Well, being together with a group of already successful movers and shakers, whether it's in property, a lot of people are in business, some of the share market, and we're going to have an opportunity for you to share some of your ideas about the share market and your new book at Wealth Retreat. So if you're interested in joining Pete, me, and a faculty of the top property, tax, finance experts, have a look at the website, wealthretreat.com.au. There'll be a link in the show notes. And why not join us on the Gold Coast later this year? Pete, another bias some of us held back by is restraint bias, the tendency for people to overestimate their ability to control their impulsive behaviors. It's really easy to say I'm going to be fearful when I'm going to be when others are greedy, and greedy when others are fearful. For me, it's a little bit different. It's easy for me each week to say, I'm going to hold back my appetite and I'm not going to have chocolate. But interestingly, we tend not to be that way when circumstances change.
No, that's right. I was just thinking to myself that hopefully Heather's not listening, but in terms of people having that impulsive behavior, you often see it in spending. Heather came home yesterday and said, I've got some news for you. She's looking a bit guilty. Spent quite a lot of money on a pair of glasses. And I said, well, there's nothing wrong with spending money on good quality glasses. But I think the real thing was it was just an impulsive purchase. And we see that behavioral trait can be replicated across all sorts of things. People struggle with, dieting or spending too much time on the phone is one of mine. I can sit there, and the restraint bias is all part of that. Life is full of temptations, and some people have more discipline than others, and others of us are, I suppose, more impulsive. So, and psychologists would say, when people are most restrained, that's where the impulsive behavior kicks in.
Interestingly, during the downturn of 2018-19, we had lots of investors who 3, 4, 5 years earlier made long-term plans to keep their properties in the long term, but kept coming to us and saying, hey, the market's falling, I want to sell my property. When their properties became vacant, when the tenants moved out as part of our property management, ongoing asset management for them, we actually had to hold people back from selling their properties. But I remember one gentleman who regularly, once a year, would say, is it time to sell? Is it time to sell? Even though we said, no, it's not the plan. He sold in May 2019, exactly at the bottom of the market before it picked up again. And now he's looking back, and I'm sure he's regretting that his properties have probably gone back up 10, 15% in the value from where they were, because they were good properties. So he thought he was sensible. He thought he was able to restrain himself. It's easy to say I'm going to be greedy when others are fearful, but that's one of the biases. Pete, I think the last bias I'd like to discuss is bias, failing to recognize these cognitive biases as a bias itself. In fact, I think the people listening to this, if we're thinking we're not talking to them, yes, we are, because these biases affect you just as much, don't they?
Yes, totally. So actually, just going back to that previous point on the property market in particular, I know that the strategy that you use and the strategy that I use is building a long-term portfolio, but we see this time and time again. When the market is falling, people just don't like to buy in a falling market. They get tempted to sell, and that's why having an understanding of the cycles is important. I would say arguably it's different for stock markets because the transaction costs are much lower and they're much more liquid. So it makes a lot of sense to be fully invested when everybody else is despondent and out of the market. But when markets are getting extremely expensive, and I was saying this at Wealth Retreat and then all the way through to January and February, people need to take some risk off the table, but they get greedy at the end. So I think it's different for different asset classes.
I think that's a really important thing. You actually don't treat real estate investing as you do stock market investing. It's very, very different. Just like you don't play Australian rules football, even though it's got a ball, the same way you don't use the same rules as you play soccer.
No, I think, it's different for a different stage in life, and there are different ways to go about these things. This is the way I view the world. Property is a fantastic way to build wealth, equity, and especially in your younger years, because you can use leverage to get ahead and you've got a long runway. I think where the stock market tends to help is in the later years, if you're seeking a tax efficient income or passive income, because it's very tax effective. The far fewer holding costs, fewer headaches. So different strategies for a different time in life, but that's the way I've always viewed property. I mean, that's just my wealth building machine. It compounds away in the background. Stock markets, you need to really take a more cyclical approach. And when they get dirt cheap, as they probably will, I suspect, in 2020, that's when you need to take action when everybody else is despondent. I would say real estate is much more about building a huge asset base that just goes on compounding away in the background. And that can be your legacy. You can build huge wealth through real estate, and stock markets can be your income. Oh,
clearly. And since the global financial crisis, and even more recently with the way the banks are funding retirement, it's actually much more difficult, first of all, to get into the property market because the deposit gap is hard. It's much more difficult to grow your asset base because the banks are looking at your serviceability differently. And it's definitely much more difficult the old strategy I used to use of living off equity is gone for almost everybody. Some people with very large asset bases can still do it. So you do need a mixture of whether it's managed funds, superannuation, or stocks. You do need cash flow coming in from other areas. So it's a balance. And Pete, that's what I've always liked about you, that you've actually had a balance of the stock market and the property feels, as opposed to if anyone says to you just property, or anyone just says shares, you probably should run away a little bit because they've got a bias, another bias. So it's a combination, and it really depends at what stage you are. So you need assets and you also need cash flow. Pete, it's been fun talking with you. I think we should probably finish off by explaining that while we all want to think we're rational, we all have these biases. We maybe see it in other people. It's often hard to see ourselves because our brains are designed to have these blind spots. Our brains are designed to play these clever tricks on us, to delude us, to make us think that we're better than we are, when in fact most of us have got some issues with money in some areas of our lives. But the other thing is we make our mistakes over and over again because we're blind to our biases. So by having this chat about biases, I hope we've made you, our listeners today, less biased. Pete, if people want to get more of your great information, and you've actually just got a new book out, quickly tell us about your new book too.
Well, the new book is called Low Rates, High Returns, and I co-authored it with Stephen Moriarty. It's really about how to invest in the new low interest rate era, so pretty timely. And I think timing's actually spot on because stock markets are now imploding and it's causing people to have a rethink about how they actually need to invest in this low interest rate era. So that's due out April 2020. So we'll probably see record low interest rates just as the book comes out. So good timing.
Perfect timing. Well, we'll put a link to that in the show notes. We'll put a link to your great blog at Go Next Level Wealth, but also the Pete Wardson blog. And of course, you write regularly for Property Update as well. And regularly, we have our chats on the Michael Yardney podcast. Look forward to having another chat with you in a couple of weeks' time. Thanks for your time, Pete.
Pleasure. Thanks, Michael.
Well, following through from my chat with Pete a moment ago, I hope you now recognise that some of the things that are holding you back are probably not what you imagine them to be. And in the scary times we're experiencing, I guess there's always scary years, there's always scary moments, but this year seems to have brought more than its share. It's easy for our brain to play tricks on us and not allow us to think rationally. When there's worries about recession, when there's worries about the property market, when there's worries about the stock market. And that's why I'm suggesting that if you want to achieve financial freedom, interestingly, these sort of opportunities are the best times. Remember what Warren Buffett said, be greedy when others are fearful and be fearful when others are greedy. Now, I'm not saying go out holus bolus and buy investment properties if it's not right for you. But what I'm saying is that if you want to get to the next level, if you want to counteract your biases, if you want to actually be more successful than most investors, you're going to need to get a good team around you. And part of that should be an advisor who takes a holistic view of your wealth. And that's more than just a bias agent, because bias agents are important to, I guess, implement the order that the property strategist may put together, but you need more than just property. So that's why I'm suggesting that you have a chat with my team at Metropole that have again won an award. We've won another award this year as Australia's Best Property Consultant for 2020. We won it for 2019. We've won lots of awards because we have much more depth than, well, actually any other team I know to help our clients. We sometimes help with strategic property advice, with property planning, with finance strategies. Sure, we've got a buyer's agency and we help people buy their homes or in their investments. We have a wealth advisory and a financial planning arm, property management, property renovations and development, and ongoing portfolio management. In other words, we provide a full range of services and you could choose some of them or all of them as a one-stop shop. How much would that be worth to you if you could have the best team on your side? One that will customise a solution to meet your specific needs. So go to metropole.com.au. There'll be a link in the show notes. And why not have an obligation-free chat with our team? We've got a time-tested system for property investment. We've been involved in over $3.5 billion worth of property transactions over the years, but we've got true on-the-ground experience in the 3 big capital cities as well. But you know what? We haven't got any properties for sale. So therefore our advice is unbiased and independent. But we've got the perspective that money can't buy. But on the other hand, you could hire our services to help you. So why not go to metropole.com.au or give us a call on 1300 Metropole, and I look forward to being part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Have you ever thought about the traits, the values and the differences between successful and unsuccessful people? It may seem obvious. Successful people are, well, successful. But they're actually more than that. They're confident, they're polished, they're assertive. That's why each week in My Mindset Moment, we spend some time working out what the habits of the rich people are, the successful people are, so that you can learn to develop more of these rich habits and get rid of some of your unproductive, your poor habits. So today I'd like to spend a couple of moments speaking about some of the ways successful people differ from unsuccessful people. And the first way is successful people embrace change, while the average person tends to fear it. Now, this can be hard to do. Uncertainty doesn't gel well with the human spirit. However, in the current times of technology and business and even in a real estate market, things are evolving daily, and those who can grasp and manipulate the change to their advantage are undoubtedly going to become more successful. And I'm getting older and I'm just realizing that the world's growing at an accelerated pace, and those who choose to embrace it rather than fear it and hide from these changes, those who learn how to harness these changes to their advantage, they're the ones who are going to be more successful. Another trait of successful people is that they talk and share and encourage ideas with other people, while unsuccessful people, they tend to talk about other people. So successful people are idea sharers, and they sort of have the concept that two heads are better than one, and they bounce ideas off each other. But yet the poor people, the unsuccessful people, just get too easily consumed by and talk about others. They gossip. They spend their time focusing on the perceived failures of others rather than benefiting from seeing how other people have been successful, how they've progressed. Another big difference between the successful and unsuccessful people is that they take responsibility for their failures, while the average person seeks to blame others. Now, if you haven't listened to episode 1 of the Michael Yardney podcast, go right back to that, where I teach you about how to be the pilot of your life rather than the passenger, to take responsibility. Truly successful people still experience ups and downs in their life, but one thing's clear: they actually accept responsibility for their actions, both their failures and their successes. They realise that no good ever comes from blaming others. I've often said there's no such thing as a rich victim. The fourth trait of successful people is they give others credit, while I've found that unsuccessful people like to take the credit themselves. That's a big, big difference. Allowing your team members, others, to have their moment in the sun to shine is a really effective management tool if you're a team leader as well. That's why successful people are more than happy to share the praise around with others. Those who don't have a positive, abundant mindset, they seem to take the opposite approach and will greedily hog all the credit for themselves, failing to see the good that others have shared. Another big difference between the successful and the average person is that successful people take pride in, and they actually want others to succeed. Now, that's not the way the average person thinks. They actually, what's that tall poppy syndrome, and they knock other people who've succeeded. And the last trait, there's lots and lots of different traits of successful people, but the last trait I'd like to just quickly mention to you today in this mentorship moment is successful people are continuously learning. Why do you ask? They're already successful? Well, because they know that there's always new opportunities that are going to allow them to pivot, to grow, to adapt, to improve in all sorts of ways. So whether you're a property investor, a business person, an entrepreneur, you've got to be continuously learning. You'll find that as a trait amongst all this wealthy people. They set time aside specifically to read for an hour or two, to learn things. They still have mentors. They still pay for courses. They are part of mastermind groups. So you can always keep learning. Successful people have lots of different traits to ensure that they achieve ongoing success, to ensure they achieve their goals. So be happy within yourself, share your wins and experiences, be giving of your knowledge, but have the drive to go out there and get it done, because that's going to help you stand out from the pack. If you want some help with this, if you want to have a mentor to help you move forward, have a look at my 12-month mentorship program. You'll find all the details at michaelyardney.com.au. For over a decade, I've mentored about 2,000 people now and seen some amazing transformations or success. michaelyardney.com.au, you'll find out all about my mentorship program. As we come to the end of today's show, I hope you understand a bit more about yourself and you've got some insights to become more financially fluent. And if you got some benefit from today's show, please help somebody else. My quest is to make as many people financially fluent so that they can get the extra success in property, investment, in money management. So tell somebody about the show. There's a share button in all podcast apps, or just tell somebody, and you can tell the world by leaving a review, 1 star, 5 star, however many stars you like on iTunes or Apple Podcasts as it's now called, or wherever. And if I read your review out, please email me, michael@metropole.com.au, because firstly, I'd like to say thank you, and number two, I'd like to gift you one of my books, as I'm going to do for Chris IG, who left a 5-star review on Apple Podcast recently. He said, I've somehow only just stumbled on Michael's works. My bookshelf is full of investing books, and I now have a clear winner. His property knowledge as well as his mindset work is a great mix, and has given me an extreme hunger to continue buying and buying and buying. Well, Chris, thank you. I'm glad that I have pointed you in the right direction, and I look forward to being an ongoing part of your wealth creation journey. Now, I'll be back again with you twice a week on the Michael Yardney podcast, but in between, you can keep contact with me on social media, YouTube, Facebook, Twitter, LinkedIn, and Instagram. Just look up Michael Yardney and let's keep in contact. I'd like to know more about you. And of course, my Property Update daily blog. I'll catch up with you again real soon, but in the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?